Hey guys, welcome back to the channel. There are so many different business structures out there, it can be hard to keep them all straight. So for today's video, we're going to chat about some of the key differences between two of the most similar, an S corporation or S-Corp and a C corporation or C-Corp. If at any point you want to check out a business formation service that can help set up your business for you, check out the affiliate link that's down in the description for a discount that you wouldn't be able to get anywhere else. That being said, let's get into it. So the first major difference between the two is taxes. S-Corps are pass-through entities. This means the business itself does not pay federal income taxes at the corporate level. Instead, profits and losses are passed through to the shareholder's personal tax returns, and then that income is taxed at the individual's income tax rate. Now, in an S-Corp, shareholders actively working within the business are paid through a salary from the company. This means in January, that shareholder would get a W-2. From that salary, the employee would then be responsible for self-employment taxes, or the FICA tax, which comes out to about 15.3% for the first $160,200 earned. But as an added bonus, shareholders can also get distributions from the company's profits. Distributions are considered a return of their investment in the company's stock. Now, unlike the salary, these payments aren't subject to that FICA tax. This way, shareholders have the potential to save some money. So what's a good example of this? Well, say in my tutoring business, I made $65,000 in revenue. After I take all of my business expenses for the year into consideration, I'm left with a net profit of $60,000. Now, out of the S-Corp, I pay myself a reasonable annual salary of $50,000. I'll get a W-2 and pay self-employment taxes on that income. That will then leave me with $10,000 of net profit within the company. Now, at any point throughout the year, any portion of that remaining net profit can be transferred into my personal checking account as a distribution or owner withdrawal. Now, if you aren't the only shareholder in the business, then there will likely be agreements on how distributions are to be split among each of the members. You can also hold on to those remaining profits and reinvest them back into the business without having to worry about taxes right away. Now, when it comes to determining a shareholder's salary, the compensation must be considered reasonable for the work performed. When we use the term reasonable, we are taking into consideration what the salary of someone else working in a similar industry and position would be. Now, the figures I used were totally made up for the sake of simplicity, so it's important to do your market research to make sure the salary doesn't raise any red flags with the IRS. Now, if the business isn't profitable in a tax year, those losses can be used to offset any other income on a shareholder's personal tax return. This means that loss can be used to reduce taxable income from other sources, like wages, investments, or other businesses. But it's important to remember the amount of loss that can be deducted is typically limited to the shareholder's position in the S-Corp stock and debt. If the losses exceed the shareholder's position, they may be carried forward to future tax years.
In a C-Corp, the corporation is responsible for paying corporate taxes, and then the dividends owners get from the business are then taxed at their individual tax rate.
This is called double taxation. So how does it work? Well, to make it easier, let's say my C-Corp makes $100,000 in profits for the year. Now, on those profits, the corporation needs to pay income tax. Right now in 2024, that tax rate is 21%. That means my company will pay $21,000 in corporate taxes. This leaves $79,000 in after-tax profits. So let's pretend I then take those profits and just distribute them to me as the shareholder in the form of dividends. When I receive those dividends, I'll then need to report them on my personal tax return. Assuming I'm in the 35% tax bracket for qualified dividends, that means I'll owe an additional $27,650 in taxes on the $79,000 in dividends. Now, like I mentioned, this scenario is totally made up. But you see, it shows you that the company pays $21,000 in corporate taxes, and then me, as the shareholder, pays $27,650 in taxes on the dividends I received. That's how C-Corp taxes work in a nutshell. But if a C-Corp would rather retain the profits rather than pass them out through dividends, they can, although they would still owe corporate income tax on that balance. Now, another difference between the two is how they handle ownership and shareholders. In an S-Corp, the maximum number of shareholders one entity can have is 100, and there are requirements of who can be shareholders. For example, shareholders must be U.S. citizens, resident aliens, estates, trusts established within the U.S., or nonprofits with tax-exempt status. Along with this, there is only one class of stock C-Corps can distribute, called common stock. Now, this is pretty basic when compared to their C-Corp counterparts. In a C-Corp, you can have an unlimited number of shareholders, and there aren't restrictions of who can be shareholders. Individuals, other corporations, partnerships, and non-U.S. residents can all be shareholders. By being flexible and uncapping any shareholder limits, C-Corps are able to raise capital by offering their stock to the public and hopefully get more investors for the business. Now, unique to a C-Corp is the ability to issue different classes of stock. The majority of their stock is made up of common stock. Common stock would be considered the most basic. Owners of common stock have voting rights at shareholder meetings, and they have the potential to receive dividends from the company, but common shareholders would be last to receive dividends and assets in the event of liquidation. Now, C-Corps have the option to give out different classes of common stock, like Class A, Class B, and so on. Each class may have a different benefit or right. For example, say Class A shares give shareholders 1 vote per share, while Class B shareholders get 10 votes per share. Depending on your class, your abilities may be shifted just a little bit. One step above common stock is preferred stock. Preferred stockholders have some preferences over common shareholders in certain aspects, like they receive fixed dividends, although preferred shareholders usually have limited or no voting rights compared to common shareholders. Now, preferred stock can be split in 2 categories. There is regular preferred stock, and then there is convertible preferred stock. Here, a shareholder can take a preferred stock and convert it into a set number of common stock. This option gives shareholders the opportunity to benefit from a potential increase in the stock's value while still being able to keep their fixed and priority payment. On top of these types of stock, a C-Corp can have a stock kept internally within the corporation. Restricted stock is one type of said stock issued to employees or directors as part of their benefits package. While the stock is granted up front, recipients may be subject to certain restrictions like a vesting schedule or performance conditions before they can fully own or sell the stock. Treasury stock are shares of a company's own stock that has been repurchased from shareholders. Treasury stock doesn't give shareholders voting rights or the ability to receive dividends. However, it can be reissued or retired depending what the company's board of directors decides. So while taxes and stock are handled a little differently between the 2 corporations, it's only natural that the way they run their operations are too. As a whole, overall, S-Corps are for the most part less formal than C-Corps. Now, shareholders hold the most power in an S-Corp, although they play more of a supporting role in day-to-day operations. The board of directors are responsible for major decisions. Officers handle the day-to-day decisions of the corporation. They make sure policies are followed through, manage employees, and follow any regulations. In smaller S-Corps, directors may also serve as officers. This structure makes S-Corps attractive to small to mid-sized businesses, particularly those that are tight-knit, like those that are family-owned or where shareholders are actively involved in day-to-day operations. That being said, S-Corps are small business friendly and also allows their owners to share stock with their employees as an incentive. In a C-Corp, shareholders are the owners of the corporation and hold the most power in the corporation. They choose the board of directors and make major decisions within the business. The board of directors are the overseers of the corporation. Directors typically serve fixed terms and are responsible for making major decisions on behalf of the corporation, like making policies, appointing officers, declaring dividends, and making sure the corporation is doing well. Now, officers are chosen by the board of directors. They take care of the day-to-day management and operation of the corporation. Officers are responsible for managing employees, handling routine business operations, and making sure the corporation is following all laws and corporate regulations. Because of their flexibility in operations and management, along with their ability to keep earnings and issue different classes of stock, they are often the choice for larger businesses. These are the business entities of Walmart, Disney, and Amazon, just to throw out a few. C-Corps generally are more structured than S-Corps. They have more requirements detailing how they are run, along with the board of directors, shareholder meetings, annual filings, and they need to comply with state and federal regulations. While this leads to more paperwork, it also leaves less guesswork in running the business, since their operations are clearly spelled out in black and white. Now, while we've talked about how C-Corps are generally more structured than S-Corps, they also have more give in that structure. For one, C-Corps can choose their fiscal year end. This means that while the rest of the world, including S-Corps, follow a normal calendar year, January 1st to December 31st, C-Corps can set their own, like a fiscal year could run from April 1st to March 31st, or from July 1st to June 30th. Now, say you already have an S-Corp and decide you would rather have a C-Corp instead, or vice versa. While yes, it is possible, the process is tricky. For starters, in the case of going from an S-Corp to a C-Corp, your shareholders will need to vote on the conversion. If the majority votes yes, then the corporation will need to adopt the more formal structured setup that C-Corps have. This means regular board meetings, detailed record keeping, following corporate bylaws and regulations, and restructuring stock. And I haven't even touched on taxes yet. Previously, the S-Corp wouldn't have been responsible for federal corporate taxes. Now they would. Then on top of those taxes, shareholders would be taxed individually too. Now, on the other hand, to go from a C-Corp to an S-Corp, your business would trigger the built-in gains tax. This is a tax on the difference between the current value of the assets the S-Corp owns, like property or investments, and their original cost or value when the S-Corp acquired them. Let's pretend my S-Corp bought a building for $100,000 when I first started. Now, at the time of transition, it's worth $200,000. This means my business would owe taxes on the $100,000 increase in the building's value. In a nutshell, built-in gains tax is used by the IRS so that the corporation doesn't avoid any taxes it generally would have owed. Now, this doesn't just apply to the time of transition. No, this tax period lasts 5 years. So if the business sells assets that would have increased in value over time, they continue to pay the built-in gains tax. If you decide to start a corporation of your own, the formation process is not totally different from one another. For starters, both need a name, both need to get an EIN from the IRS, a business bank account in the name of the corporation, a registered agent, and any permits, licenses, or insurances your business may need. Both need to file articles of incorporation with the state to officially start the corporation and pay any required fees, which vary by state but typically range from $50 to $300, and both need to draft their own bylaws on how the corporation is expected to run. Now, on top of all of this, both corporations need a board of directors, shareholders, officers, and will be able to issue stock, even though an S-Corp has more stock limitations than a C-Corp, and naturally both have duties they need to fulfill to keep the corporation running. With so many things alike, it may start to feel like nothing is different, but that isn't the case. Like newly formed C-Corps are required in some states to file an initial report or statement of information shortly after incorporating the business. Then in an S-Corp, there's an extra step you gotta take to make sure you're being taxed as one. That is to file Form 2553, called Election by a Small Business Corporation with the IRS. This needs to be done within 75 days of incorporation. This is what is going to let you enjoy the tax perks S-Corps have. Now, I know all this can feel intimidating. Having a business of my own, I get it. But we are so fortunate to be living in the 21st century where we have access to the internet and business formation services like LegalZoom who can take care of forming a business for you. Now, LegalZoom can do more than just start your business. They can help with trademarking, getting patents, copywriting, taxes, business licenses, and the list truly goes on and on. I used a business formation service to start my business. And honestly, the process was faster and less stressful than starting my sole proprietorship or my own. Forming your corporation with LegalZoom is pretty straightforward in my opinion, but I'll let you make your own as we go through the steps together. The first step is to enter your business name and select the state you're incorporating in. From there, they'll ask for your email and phone number, but this part is optional, so you do you on this one. From there, they ask some general questions about your business, like the products or services you offer, and if you plan to hire employees within the first year. Based on your needs, they'll offer services they have to make things easier on you, like getting an EIN, drafting bylaws, and even attorney services. There's no pressure to take those services, although it's nice to have options for some extra help. The choice is still totally up to you. Now, those individual services that are offered to you as you complete the application are only part of the picture. There are plans they offer as well, depending on your needs and budget. The simplest option is the economy plan. For $149 plus your state filing fees, LegalZoom will process your corporation application within 5 to 14 days before passing it off to your state. Now, there are some extra benefits too, like they will run a background search of your chosen name to make sure it isn't already taken before filing your application, a peace of mind review of your application to make sure it's complete, and a business newsletter. Now, while those are all good things, there are some other perks that come with this plan that are really valuable benefits. Like LegalZoom will get you set up with a free Wix website for your business, give you the opportunity to work with a small business specialist to help you with all the necessities to run a successful business, a complete digital welcome packet that includes your state's articles of incorporation with step-by-step instructions for what to do after your corporation is formed, and 7 days a week lifetime customer support. Now, one step up is the standard plan. So for $329 plus your state filing fees, your paperwork will have priority status and be processed within 5 business days. And yes, you get all the goodies we talked about in the economy plan, plus the deluxe founders kit to hold all of your important papers and a personalized notebook with your business name on the cover. Now, finally, there is the Express Gold. For $349 plus state filing fees, you get everything you get in the first plans, plus expedited processing. This means your application will be prioritized and processed within 1 to 2 business days, and if allowed by your state, be prioritized there too. Your documents will then be shipped priority to you. So starting a corporation doesn't have to be an intimidating process. It can be simple with tons of support from professionals wanting to see you succeed. Now, that being said, I see LegalZoom as one of the best business formation services out there, especially for beginners like me, because they take care of everything on your behalf. Now, don't get me wrong, there are other great services that I've also tried, like Zen Business, Taylor Brands, and Swift Filing. So I'll go ahead and leave some review videos down in the description if you want to learn more about them too. Now, when I was just starting my business, I thought I could DIY my way through the process. After tons of mistakes and hours on hold with my Secretary of State's office, I started searching online for help. After a lot of soul searching, I came across LegalZoom. After weighing my options and being in a bit of a time crunch at this point, I chose the Express Gold option. Now, I understand it is the more expensive of the 3, but I feel like the benefits they offer outweigh the cost. So, just as a quick recap, in terms of taxes, S-Corp shareholders pay taxes at their individual tax rates, while C-Corps pay corporate taxes on their profits, and shareholders pay again on dividends and something called double taxation. S-Corps have a limit of 100 shareholders and have restrictions of who can own shares. C-Corps have an unlimited number of shareholders, and anyone can be a shareholder. S-Corps can only sell one type of stock, while C-Corps have several. In terms of structure, S-Corps are less formal. Here, shareholders are in charge, but the board of directors makes the big decisions. Officers run day-to-day operations. S-Corps are really good for smaller, tight-knit businesses where everyone's hands-on. In a C-Corp, shareholders are in charge. They elect the board of directors who oversee everything, and the officers run the business day-to-day. C-Corps are more structured. There's a bit more paperwork, but it's clear on who's responsible for what. In a nutshell, S-Corps are simpler and more flexible for small businesses, while C-Corps are better for larger operations with more opportunity for growth. Each has its pros and cons, it's just a matter of picking what works best for your business goals. And that's gonna be it for today's video. I really hope you found this video useful, and if you did, please hit the like button and subscribe for more. And as for those discounts I mentioned at the beginning of the video, if you want LegalZoom to help form your business, check out the affiliate link in the description for discounts you wouldn't be able to find on your own. And be sure to check out my in-depth review of LegalZoom. Also, feel free to leave any questions in the comments below, and I'll try my best to answer them as soon as I can. Thanks again so much for watching. See you next time.